journalists, good members of the public. You are welcome to the 9th edition, the 9th episode of CITN, Taxation and You. Today we'll be doing with a topic titled, How are foreign companies taxed in Nigeria? How are foreign companies taxed in Nigeria? I'll need to do justice to this topic is Mr. Sandra Muma. She's an associate partner in EY. Mr. Sandra Muma, welcome to the program.
Thank you, sir. Thank you.
Thank you for joining us. This program, just a quick overview. This is a program where we interact with, of course, members, naturally. But not just that, we also interact with taxpayers who do not the technical nuances about taxation. Right. So some of those are terminologies we need to have to simplify them for them to understand. We have to also discuss tax from the perspective that can enable business owners to put in part of their corporate culture the tax obligations that they're required to comply with. So thank you once again for being here.
Thank you for having me.
So to go straight to the point, when can a company be said to be a foreign company for the purpose of taxation in Nigeria?
Okay, thank you. So based on CITN, foreign company was defined as a company established outside Nigeria. So more like a company incorporated outside Nigeria. And then from Nigeria taxation system is based on residence. So residency based, what does that mean? A company is resident in Nigeria if that company is incorporated in Nigeria. So for tax purposes, a company that is incorporated and resident in Nigeria is subject to tax on worldwide basis. And what does that mean? The income both from Nigeria and outside will be subject because you're a resident. So taking it for foreign companies. So foreign companies are also subject to tax in Nigeria from the income they derive from Nigeria. So only the source income. So comparing, so for conversation today, we'll be looking at the interchangeably using non-resident and foreign companies because of the taxation purposes. So taking its income, right? I spoke about income derived by foreign companies in Nigeria. And you can also divide that income into two, passive income, active income. So passive income, you're referring to dividend, interest, and all that, royalty, that does not require any activity to be performed. So your investment is working for you, you're getting income. So when a non-resident company is deriving such income from Nigeria, definitely is going to be subject to tax in Nigeria. So because Nigeria is the source country, both based on domestic tax law and the tax treaty, we'll talk about tax treaty as we go on. Tax treaty, the taxing right is given to the source jurisdiction. That is the source country where the income is coming from in terms of passive income. So then another point again, I mentioned passive and active.
Active, yes.
So right now we go to active. So active had to do activities. So you're carrying on business activities in Nigeria and all that. And at the end, you have business profit. So the same thing, CITN also talked about how the profit of a non-resident should also be subject to deemed derived from Nigeria so that it will be subject to tax. And there are conditions under which the profit of a non-resident company could be deemed derived from Nigeria and as such be subject to tax in Nigeria. So there are various conditions. So one had to do with the non-resident has a fixed place of business in Nigeria through which is carrying on his business and the profit is attributable to that fixed place of business. Fixed place of business can be an office, factory, and all that. So if there's no fixed place of business, the non-resident is carrying on business in Nigeria through an agent. So the agent is entering into a contract, conducting his business on his behalf. So the non-resident income could be deemed derived from Nigeria if that case applied. That is second. The third option had to do with a non-resident that is carrying on turnkey projects. So I would define turnkey project. What does that mean? A single contract that involves survey, delivery, installation, or construction. So when you are engaged in such contract as a non-resident in Nigeria, the profit will be deemed derived from Nigeria and subject to tax. So the fourth point had to do with the artificial transaction. So when a non-resident is having an activity with a related party, and the pricing of that transaction is not at arm's length. Artificial, the tax authority can deem the profit to be derived from Nigeria and as such subject to tax. So that is the fourth point, right? Then we have addition based on Finance Act 2019, addition in terms of digital services, significant economic presence. So the fifth one will be the non-resident that is carrying on digital services. One criteria had to be if the revenue is more than 25 million, then digital services relating to online streaming, downloading, and then provision of goods through a platform. The non-resident could be deemed, the profit will be subject to tax where the threshold 25 million is met. Then the second point under that digital service had to do a non-resident that has a website or registered a website in Nigeria. Or the third point, the non-resident that is carrying on purposeful sustain activity through a digital platform. That is digital. That is the fifth point, digital services. So that and this fifth and the sixth one I'm going to also talk about came in through Finance Act 2019. Okay. So prior to Finance Act, we had only the four option points that I enumerated earlier. So the sixth point had to do with a non-resident that is providing TPMC. So TPMC, technical, professional, management, and consulting service, and they're being paid in Nigeria. That income will be subject to tax in Nigeria, and also Finance Act provide that should be withholding tax. So looking at that, so that is when you can look at it, the profit will be deemed derived, and then foreign company will be brought to tax net in terms of taxation. So that is that on domestic tax law. Another point also that will be looked at, non-residents that are coming from treaty countries. So treaty tax treaty is a double tax treaty agreement signed between countries in terms of taxation and all that. So Nigeria has tax treaty with a number of countries. So a non-foreign company that is coming from a jurisdiction where we have a tax treaty. So determining when and how they should be subject to tax in Nigeria, you'll be looking at the provisions of the tax treaty.
Well, thank you. You've kind of taken us through the more than the foreign companies actually it's not very various myriad of ways through which whether they're fiscally here or not, artificial transaction, the digital services and all the rest. Okay, yeah. So for our lay members who are listening too, so in specific forms, what are the kinds of taxes or type of taxes paid by foreign companies in all of these areas, none of these places mentioned? Can you share with our audience? Okay, so starting point will be, first of all, what are the taxes applicable in Nigeria? Okay. So we'll start off companies income tax, so CIT. So like the explanation I gave, when your profit is deemed derived from Nigeria based on the conditions, then it should be subject to companies income tax. So foreign companies will be subject to CIT, companies income tax. Then also Nigeria operates withholding system. So if you're is an advanced payment of income tax when it relates to active. Remember the active income I mentioned earlier, differentiating between passive income and active income. So withholding tax on that will be an advanced payment of income tax. So that should also apply where your income is subject to tax, CIT, then the withholding will apply. And based on the tax law, the Nigerian company is expected to deduct from the income that is due to non-resident under withholding tax. So another point again, another tax will be capital gains tax. Okay. And capital gains tax is based on assets, and recently Finance Act amended to include shares. So non-resident that is having chargeable gain in terms of disposal of shares and others, CGT we apply, and also assets that are located here or that. And if you go to CGT, there are different location for different assets, okay, depending on what the non-resident is disposing and the location of assets. Then CGT could also apply. Then another tax, VAT, right? VAT law also amended in section 10 to require non-resident company that are supplying taxable service to Nigeria to register for VAT, include the VAT in the invoice, register, and also do tax filing. So bringing them also
to TaxNet in terms of VAT, and if they are consuming taxable services, also VAT will apply. Then the next tax are also stamp duty, which is also had to do with contracts, and that had to do if they have stamp duty is payable on instrument, right, okay, relating to property or something done or to be done in Nigeria. So if there's any property or activity that are related to Nigeria that the non-resident is part of, them, we can talk about stamp duty that could apply. I think that summarizes.
Thank you, Mrs. Pomba. You're making it very simple, very interesting. I hope our viewers are connecting what we're discussing and also picking the points and the more potential part. And now I want to take my question is to go on non-resident foreign companies. Let's take a practical example. Some video communication technology, for example, Facebook, Meta, corporation, and the like. So we subscribe to Zoom to do something, and we see them charge VATs. Right? Also, video corporation and on Facebook, we do some ad and all that, using that, they charge VAT and all that. How are they able to register? How can they get registered in Nigeria? How does it work?
Okay. All right. Thank you so much for that question. So non-residents are based on FRS guideline and all that, that's as I indicated earlier, those conditions and all that. So you're providing taxable supply. So like the example you gave, there's a Zoom service, you are the one consuming in Nigeria. So there's a taxable supply. Okay. So the Nigerian customer, like the case you gave, will be the one bearing the VAT, but the non-resident that is providing that is required to register with the tax authority. And the registration process had to do with the completion of non-resident taxpayer form, attaching your certificate of business and not corporation as part of that. And then based on that, FRS will issue tax identification number to the non-residents. So in addition to all that, you also complete VAT form. And then you also, the non-resident will complete a tax update form to have access to, tax promas for e-filing and all that. So that is the process submitted. I think for Lagos Ikoyi tax office, international tax office process, you submit and they get your TIN. You have access to tax promas for filing and payment. But another thing that I've seen in practice regarding, because non-residents, some of the transactions will be in foreign currency, like now VAT and all that. You will not be able to make that payment because the tax promat has not been configured for foreign currency payment. So you have to do the filing manually with the tax authority. Okay, thank you. So I need to work for FRS or for your national partner, Sion. Are we saying in practice, for a fact, there are companies like video technology, Pass, Alphabet, the owner from Google, are we saying they are registered legal and formally in Nigerian tax authority for purpose of filing and remittances of these banks that are charged? Is that the case? Yes, non-residents. So based on the provision of the law and all that, non-residents, they are registering, and some of them that will have as clients, they register with the tax authority for the purpose of filing and all that. And then in addition to that, 2021 Finance Act also, it was indicated that non-resident, FRS tax authority can appoint as an agent, and we've still that coming, some appointed as an agent to collect the taxes. Because there's another thing, right, in terms of that VAT. Okay, let me just leave it as we go on. So that
So now you gave a dissection on real some of foreign companies. It's all not in the form most of us will know. It's way wider. The turnkey project, the data science, transactions, so many type of taxes. You treat all of them as ordinarily. So is there any difference between the taxes, those kind of taxes you mentioned? Are there differences between the portion that are paid by fiscally present foreign company and those companies that are not fiscally present? Is there any difference, or is it just all the same?
It's the same. So the tax law is structured in terms of, so the analysis I gave creating permanent establishment or significant economic presence. What does that mean? You have a taxable presence. And once the foreign company has a taxable presence, automatically you're subject to tax. So we now look at the taxes that should apply based on the income and activities. And then, like I enumerated the taxes. So based on circumstances and transaction, you'll be able to say this tax will apply. CIT, profit, if you have a permanent establishment or you have significant economic presence, CIT automatically, whether, and then maybe to differentiate that. So when you talk about physical, without physical, so it's more like virtual.
Okay.
Physical, you're here. So, and that had to do with the permanent establishment conditions that I enumerated earlier. Those four, we give you physical because you have to be here.
Okay.
Fixed place of business, you have someone entering into a contract on your behalf and all that. Why the 2 points that came through finances is dealing with virtual. Okay. So, but what we are trying to establish is taxable presence. So once there's taxable presence, automatically the income and all that will be subject to tax. Then when you go into CGT also, depending on the facts and circumstances, disposal, chargeable assets, chargeable gain, then that tax could also apply. So it had to do with the transaction and activity. So there's no different specific tax.
Okay. Transaction itself.
Yeah.
Rather than the professional presence or not of the entity.
Yes.
That makes sense.
Thank you. Thank you.
I think that our viewers and listeners can connect with that. So we go over to what currency for a foreign company, because they are foreign company, what currency should they pay their tax liability or and computed or monetary obligation? Is it an Nigerian naira or is it the currency of the home country? Of that, or how does it work?
Okay, so usually we have specific provision in tax law regarding transaction currency. So for VAT, the VAT is USD. So expected to pay the VAT in USD. So based on the currency of the transaction, then the taxes are deemed to be fair. So another point also is regarding taxes that you need to, maybe you're preparing your financial statements and all that. Some companies are regarding on the currency to prepare their financial statement. When that is also prepared, and that will apply. So, but what we have had to do with the transaction, the currency, based on the transaction contract agreement, if it's USD and other US taxes due, also expected to pay the tax based on the currency.
Okay, so it depends on the currency of the transaction. So if the naira transaction, you pay in naira.
Yeah.
Dollar, pay dollar, USD, pound sterling, and all that.
Yeah.
Okay. I think that's where our audience also take into account. Now, these online transactions,
yeah,
right? Maybe someone is streaming movie on Netflix, right? Even this, Netflix show max. We are streaming sports activity, maybe on DAZN, on BT Sports, all of different companies. Now, I don't know, how is it possible, the track of these things, how are they tracked? This is not like somebody sold shoe from a mall in UK and all that. Somebody is streaming somewhere, the server is not in Nigeria and all of that. With our credit or debit cards. And somebody establish virtual accounts where we swap our naira to certain other accounts that are not used for payments. And how is this dealt with by the tax authority? In fact, how does it work?
Okay, so I think one of it for Nigeria is that we operate withholding tax system. So in that regard, automatically you're dealing with a customer, a company in Nigeria that is making such payments. So there's a law already that says when you're making a payment, you're expected to withhold tax on such transactions. Through withholding tax, they can be tracked. That is one. The second one is on the VAT I mentioned, where the law requires you to register. If you're providing a taxable supply to someone in Nigeria, you have obligation to register. Second point, so there's already an obligation based on the law for you to register, and that could track. Then the third point had to do with Nigeria has signed up exchange of information.
Okay.
Multilateral competent authority agreement, various agreements whereby they can share information with tax authorities in other jurisdictions. So through that information exchange, tax authority will be able to get information regarding a foreign company operating in Nigeria and to confirm. So through that, the information they can be tracked and that will be gotten. And then also the digital services that we mentioned earlier, through that also they will be able to track in terms of that. And then maybe also transfer pricing. Most of our transfer pricing, multinationals, related party, the subsidiaries in Nigeria, the parent company is in Netherlands. There's already a transfer pricing documentation. And based on transfer pricing rules, in terms of 3 regarding master file, local file, and country by country reporting. So the country by country reporting filing also provide information, and through that, tax authority can be able to know and track such companies. Yeah.
Well, thank you. Thank you so much for that clarification. Now, but for these very companies that have paid this or that pay these taxes, are they also required by their home country to pay taxes on those transactions, having even paid a portion here in Nigeria? How does it work for them at their own country? Now, let's even put Nigerian companies in picture. Yeah. We have, these banks that have branches all over in UK, in USA, Cayman Island, and all that. All right. We have our, FMCG present in Tanzania, Zimbabwe, South Africa. Now, they are interpreting what we are saying here. They pay their portion of those taxes, but then coming into Nigeria, those income flowing in now, do they still pay profit and taxes on those?
Okay, so for Nigeria, I mentioned our taxation system is residency based, and automatically a company in Nigeria, you are subject to tax worldwide, which means income coming from maybe Kenya, Ghana, and all that will be subject to tax. But the good thing for Nigeria is that we have a provision in CITN, Section 23, that talks about income in abroad relating to interest, dividend, or that in abroad, brought in through government approved channel is exempt from tax. So if you're earning that income, maybe you have a subsidiary in Ghana and you're bringing the dividend, once you bring it through government approved channel, there's an exemption. So if there's an exemption, it means it's eliminating double tax. It will not be subject to tax in Nigeria. And we also have a credit system, credit to be given based on CITN that is being provided and all that. So taking it to other jurisdictions. So worldwide, we have countries that operate worldwide, China, Korea, US, worldwide based like Nigeria. Then we have countries that operate source, territorial. So that's wherever you're resident, once the income is coming from their jurisdiction, so you have UK, Canada, and all that in that space, territorial. So what happens is this, for the worldwide, like I can explain for Nigeria, they could provision in their domestic tax law, like what Nigeria has, for you either to exempt or give you credit. Then also, tax treaty agreement also provide, one of the objectives of tax treaty is to eliminate double taxation.
Okay. So
provide how that your profit will be subject to tax in that jurisdiction. So if you look at it, some of the tax treaties, let's use Netherlands. Okay. Nigeria has a tax treaty with Netherlands. So you have an entity coming from Netherlands to Nigeria, definitely worldwide basis. The implication is that that income should be subject to tax twice because it's coming, and also but the tax treaty provides under condition, which ordinarily should be subject to tax where you're resident, then only subject to tax again in other country if you have what is permanent establishment. When I was talking about CITN, I mentioned permanent establishment and others. CITN actually has it as fees-based, but if you go to tax treaty, am I becoming technical?
No. I get you. Thank you for pausing. No, go ahead. No, we are following.
Okay, yeah. All right, thank you. So if you go to treaty, specifically Article 5 talks about permanent establishment. Then Article 7.
Okay, now one language, that's what we call fees-based.
It's fees-based, yes. Okay. CITN fees-based and the permanent establishment. Even the article defined what could create permanent establishment. One of them is that place of management, your office, factory, workshop, oil and gas well, and all that. Construction contract, some treaty has 3 months, some treaty is 6 months if you are carrying on such contract in that jurisdiction, or installation related to equipment that you purchase that is more than 6 months, like UK treaty talks about the percentage of the sales price. So all that will create a permanent establishment. So when you now go to Article 7, dealing on business profits, so the profit of that company will be subject to tax in the other jurisdiction, like Nigeria. If, the company is coming from Netherlands, if created permanent establishment. So, I enumerated what will create permanent establishment. So if they've created permanent establishment in Nigeria, then their income will be subject to tax in Nigeria.
Okay, so what about if it has been taxed in the Netherlands and they have the permanent as well in Nigeria? It also now be taxed also in Nigeria.
So that's why I gave example regarding exemption or credit. Depending on the domestic provision of Netherlands, they can provide, like the way Nigeria provided for some income, that once that income comes in, there's an exemption or certain credit will be taken or taxes you pay. So looking at, depending on the provision in that country, on how that will be eliminated.
Okay. That's going to define what portion of that income or profit that will now be taxed here or not.
Or whether exemption will be given or credit will be given total.
Wow. But that looks, that looks very advanced for business owners to a massive international trade and with presence across countries. Thank you, Mrs. Sandra Moma. We've gone 30 minutes into the beat, and we still have a question for you here. Mrs. Sandra, want to go to our audience. I think we are having people who will be having questions, who will be having input commentaries. We are going to take written comments, and also for our member who have things to say, you may use the palm icon, just the palm icon, activate it. When you activate the palm icon, we call on you, you're mute, make sure your background is clear and free of noise. You introduce yourself, set your membership number. If you're not a member, just say your name, then what you do. So we'll be taking the next few minutes to entertain questions, commentary. So for those who want to voice their comment, please use the palm icon on your display, on your toolboxes. Use the palm icon that will call on you to make your comment. So team, can we have the charts? Okay, fine. So what we have, okay, we have one, I guess I'm correct, Mr. Sunkomi Ogumbaye. Mr. Sunkomi Ogumbaye, if you are there, you may unmute and go ahead with your comment.
All right, good morning, everyone.
Morning.
Good morning, Mrs. Sandra. Good morning, sir. So I have a very quick question. So one of the subsidiaries of the company that I work for, am I very clear, sir?
Yeah, we can hear you.
One of the subsidiaries of the company that I work for is actually into entertainment industry. And then we have Netflix US as one of our clients. So we get payment from them from time to time. But one of the issues that have come up over time is the issue of VAT, whether we are supposed to add VAT to our invoice or not. We've been contesting this for a long time. And because their point really is that the service is that because we usually put our movie on their platform for people to watch all over the world. So my question really is, I want to know in that kind of transaction, because they are based in the US, are we supposed to add VAT to our invoice or not?
Yeah.
Okay, go ahead. Okay, that's all right. Thank you. Please take note. When you want a proper professional position, you need to consult Mrs. Sandra Moma. She's also a partner at EY. And so we are not trying to give you a signed, contractually committed opinion here on this program. You have to pay them, right? That is where our members make their income from. So we won't fritter it away. Tell the company to get in touch with Mrs. Moma at EY for a proper dimension. But I'm going to leave her to give an insight on general on what you've asked. So listen in, Mr. Sukomi. Okay, madam, over to you.
Okay, thank you. So Sukomi, if I understand in that regard, you're raising your invoice to Netflix US, right? So and that is more like a spotted service. You're providing service to them. So more like exporters service. So prior to Finance Act, ordinarily we can argue that that is exporter service. But the condition here is that if they have the Netflix, definitely we need to analyze detail the kind of services they are providing. So if they fall under the digital services and all that, definitely didn't provide details. If you have detail to analyze that they have a taxable present, then your argument to say that is an exporter service. If you have a taxable presence in terms of maybe significant economic presence here that we are talking about providing digital services through a digital platform. So the position taken is that you can't say that that service is outside. It is going to be deemed consumed in Nigeria, and as such, there will be VAT risk. But like he indicated, it would be good to have details and the proper analysis will be done to have a position. But generally, that is that on it. Thank you.
Okay, thank you, Mrs. Moma. So we have to keep the questions, commentaries, opinion coming. If you do that, use the palm icon. Like we said, use the palm icon so I can call on you to make your inputs on the matters we have at hand. Mrs. Moma, I want us to go further into this. Now, what happens? A foreign company that does not have using the language everybody understands, does not have the fiscal fixed base in Nigeria or fiscal presence. If for any reason, whoever that transacts with them in Nigeria, aided in making them not to comply with our tax law. This guy is in Silicon somewhere in California. This guy is somewhere in Dublin, Ireland. This guy, how do we go after them? You know, in Nigeria here, take it to court and all of that, right? How do we deal with foreign companies that fail to comply? What are the modalities around that?
Okay, so maybe I will just give a background to that issue and then give a response. So looking at it, you know, that challenge is not only Nigeria.
Okay.
It has been a global challenge, i.e., it started because tax laws, tax treaties that we spoke about were drafted without taking into consideration what we are having right now. Digitalized company, digitalized businesses, like what I enumerated that could create a PE. You find that you need to come, you need to have someone. But right now, based on digitalized, I don't need to be in your country. I will be in my country and I'm doing business, getting income. Exactly. So how are you going to track me? How will I be taxed? So that has been global issue. Okay. So they had to do that, made OECD to have.
Sorry, OECD, tell me, what does OECD mean? Sorry, we're having to.
So OECD.
What do they do? What do they do?
Okay, so
organization for economic.
They provide guidance in terms of taxes, global tax rules that countries can apply. Fine is not legal backing, but it's persuasive. Okay. So you see a lot of things like transfer pricing. We have OECD guidelines, and interestingly for Nigeria, our TP regulation refer to OECD guidelines.
So because of the other economic cooperation and development,
making everybody to, you know, having a uniform way of addressing a global issue. So they provide recommendation and all that on how that should be tackled. So the issue now that you mentioned, you're particular about Nigeria, but it was not actually, it's a global, it has been a global issue. So OECD started working 2013 on what we call BEPS, base erosion and profit shifting, because it has seen that multinationals are taking advantage of that loophole in the tax law to shift profit from one jurisdiction to the other. And so they started work that 2013, and the 2015 they came up with BEPS action plan, about 15 action plan on how to address some of the challenges. But one of them is the first action plan, addressing tax challenges arising from digital economy. So 2015, they started work. They've been on it, working. I don't know, some of my audience will hear about Pillar 1, Pillar 2, or that BEPS 2.0, the 1 point, all that is trying to find a global solution to a global issue. So not peculiar to Nigeria environment, and they came up with different recommendations. And you can see in 2018, they came up with some recommendation that gave some country leadway to implement this significant economic presence. We are talking from Nigeria.
Okay.
So you go to some country, they call it digital service. They have what we call digital service tax. Digital service tax.
Okay, DST.
DST is a tax on online advertising. UK, India, and all countries, they have it to track. And then, but the condition OECD gave them that fine, countries can go ahead to enact law in order to tax, so that you can track those transactions. I hope I've not lost.
No.
So that you can track those transactions and tax those transactions,
okay,
pending when a long-term solution is found. So you find out that companies that have enacted some tax rule for DST, those tax rules are temporal, because OECD is currently working on a long-term solution. But unfortunately, Nigeria is not signing up on those pillar one. We have some concerns on it, on how to address it. So to come back to that question, well, how can you track it? So what countries have done is to introduce that digital services, significant economy, because if you're going to track someone, there should be a law.
Okay.
Before law, there was nothing. They were taking advantage of loopholes and they're doing business. If you take them to court, there's nothing in the law. But right now, countries are enacting laws and they're driven by this OECD pillar one, pillar two that is on, which in terms of pillar two, minimum tax rate. So let me just explain that.
Okay.
So how will minimum, why? Because you're saying base erosion, profit shifting. So companies are shifting profits from one jurisdiction to another. Why?
Nigeria to Switzerland.
Switzerland, why? For example, let's say Switzerland, 18%, let's use 80%, Nigeria tax rate is 30. Definitely as a company, you will structure your transaction in a way that you have more profit in Switzerland because the tax rate is low.
Okay.
Although activities are performed in Nigeria.
Okay.
So there's a profit shifting that OECD is trying to address. So they are looking at, if we have a minimum tax, so they are looking at a minimum tax of 15%. If we have a minimum tax that applies, if your profit is coming from Nigeria or from Switzerland or wherever, it's not subject to a minimum tax of 15%, then the parent company will do what we call top-up tax. We pay additional tax. So to discourage you not to shift, ensure that the profit. So those are the solutions. Pillar two. And then pillar one is also there, complex, that had to do with amount A, amount B, and amount A had to do with reallocation of, NESOS had to do with what is creating taxable presence for you in that jurisdiction. So we talk about physical presence, and now it's now moving into markets, because you're dealing with digitalized activities, digitalized economy. So it's not about physical presence, but it had to do, like the example you gave, where is the market? The people, they are here, they are in Nigeria, they are the one buying your product and all that. Fine, you can be located outside, but where is the market? So they are looking at a way to allocate more profit to market jurisdiction. So that market jurisdiction deem that you have the customer, the base and all that, where those activities. So it's more like changing international tax rule in terms of allocation of profit. So it's so complex on that. So that is what OECD is doing to get solution in terms of global perspective. So for Nigeria now, we can, the withholding tax mechanism that I mentioned earlier can help us track.
That's good.
Then also the information exchange. If we find out, you can, Nigerian tax authority can liaise with other tax authority, and they will obtain information about a foreign company in terms of taxes paid, and be able to have information. Then
yeah, I get it.
Okay.
That now helps. When there is some information, they have a robust information to now decide on what they do.
We do less and all that. What are you going to? Yeah.
And this involving tax pillars, right? Because very area, we want international business owners to also connect with Please, when would you call on you on that? Please make time for us. So the question, I think it is spring. That is a time we are on top. He says, the question is, all these people that work as freelancers, 4 and 5 and are paid in foreign currency, and such expenses have been taxed, will they still get taxed here and how? I don't think I have that information. I don't think, is there anything that make out of that? Because I think not having detailed information on that.
Yes.
Yeah. Or not work and 5 and are paid in foreign currency, and such expenses have been taxed. Will they still be taxed here in Nigeria and how? I don't know. Is that if it's not clear to you, let's move on to the next one.
Okay, let's go to
okay. Okay.
Yeah. So maybe additional information will be provided. So it tax here. So is talking about personal income tax related, or not companies income tax. Okay. I guess that's what it's. But we can move on to the next question to get clarity on that. Yeah.
Okay. Someone is asking something we're not be able to. Do we have data to back the assertion that multinational corporations use loophole in tax law to shift profit to their home country? I think FRS will give you answer to that, right? Because they consolidate all of that. Someone, I can say Pam raised up, and I think that Mrs. Celestina. Mrs. Celestina, you may unmute and speak. Please make it snappy because we have about 10 minutes to go.
Oh.
Mrs. Celestina, please go ahead. Unmute and speak. Mrs. Celestina, if you are there, you may unmute and speak. Okay, maybe because she's saying her grace. Okay, so let's go. While we're waiting for, so someone is asking. So Chief, take note. Someone is asking. Kolade Oguntoke, take note of his details. Asking what are the steps to take to become a CITN member. So take note. Kolade Oguntoke, also get in touch with Secretariat for a proper briefing of how that plays out. And someone is asking whether this will be available or sent to email. Please follow CITN on Facebook, on YouTube, on LinkedIn. You get all this recorded, even the previous edition. You have them there for us to look at. But I'm on to now. Let's come to our African region proper.
Yeah.
Right. We know about the African trade, trade agreement, trade area, and all of that. Does it have any impact? What does it do with respect to foreign companies and the tax obligation in the Nigerian system?
Okay.
Does that get any resources, get any link whatsoever for African countries that are signed on and are committed under AFTA?
Yeah. Okay. So AFTA had to do with a continental agreement with all African countries, which are about 54 African countries as signed up, and then the initial shipping launch January, and the effective October some transportation and goods. It had to do with goods and services.
Okay.
Dealing countries in Africa should be able to transact with each other in terms of goods, services, and also it involves movement of persons, capital, and investment without restriction. So in terms of the different protocols, so for example, I'll give for example, a company in Nigeria, so a product is manufactured in Nigeria and you're going to ship to Ghana. Okay. For example, non-tariff custom duties being waived, and you can easily move that product to Ghana and you sell. Or company in, there's something we call the country of origin. So if once that product satisfies that, then it can be moved within and you get the exemption from the custom duties, and also the same thing applying to services and all that we apply. So it's a good thing for Africa. And then based on World Bank, the operationalization of AFTA is going to lift over 50 million Africa from poverty. So that is a good thing. And then all eyes is on Africa if this will be implemented. So taking it to in terms of foreign companies. So you find out that treaties, even the bilateral treaty, the tax treaties that we spoke about. You have find out that countries even in Africa don't have much treaty with themselves. So if you like now, for example, Nigeria, South Africa is effective, while Mauritius is not ratified. So few countries that we have treaty with. So if we have something that will make us to have business together without restriction, movement of goods, so it's a good development. And then it will enhance investment opportunity across Africa. So it's going to help having that international trade with limited restriction in terms of tariffs, non-tariff, and the movement of people. You imagine having African Union passports, so you can move in and then or transportation of goods. So that's what they are looking at. So exactly what we have in EU, right? Trying to implement in African countries to move goods and services and then, yeah.
Thank you for that elaborate explanation. So does it mean now for a layman, for the layman listening now, someone say, okay, if I sell to Ghana under the Act Canada, that means the profit I make will not be taxed in Nigeria?
Entirely in terms of the tax and all that. But now they are looking at specificity in terms of the tax treaty, tax that will apply on that. Yeah.
Okay, thank you. Yeah, our time is up. We are just going to take just one question, just one, and we are done because we're out of time. So I go to Dr. Lady former. She was so you can come on Dr. Lady from Obieri, you have the floor, ma'am. Just 45 seconds, please, to wrap up all that. Thank you. Go ahead.
Thank you, sir. Good morning once again, Mrs. Sandra. This question goes to you. I would have decided to ask you this privately, but for the benefit of other participants, let me just ask a question on this transfer pricing disclosure form on the issue of a company that has a physical presence in Nigeria. And what the company does is to install and service machines to Nigerian companies. And the issue of transfer pricing came into play, and the issue of this transfer pricing disclosure form. Please, can I have a little little ideas on how to handle such a situation if it arises? Thank you.
Okay, Dr. Bieri, thank you so much. Our title is not on transfer pricing, right? We'll be dealing with that some other time, right? But I'm going to let her give you a little insight because we're out of time. So just to address what she raised on transfer pricing quickly.
Okay, so for transfer pricing position, so transaction, definitely you're dealing with a related party. So based on TP regulations, you're expected to prepare a TP documentation to demonstrate that the pricing of that transaction is arm's length. And what does that mean? Arm's length had to do with you're dealing with your related party that can be controlled in terms of how much you're charging for that product. So if you're dealing with an independent party, how much will you charge? So if I put that price that you charge an independent party and the price you charge your related party, are they the same? For me to conclude that that transaction is arm's length. So you're expected to do a TP documentation based on regulation that will put together to demonstrate to the tax authority that the pricing of that installation service that is being provided by your related party is arm's length. So that's that on transfer price. And you're expected to file TP return, and that is the disclosure form that you spoke about to say that this is the transaction with your related party. Provide every information that you have within the year. So that is the compliance TP requirement that is required from you from Nigeria perspective, once that transaction is with a related party. Thank you.
Well, you made it so simple. The way you explain the transaction, you can remove the chat stuff so I can see, you can remove the chat. So thank you, make it so simple. Way to define the meaning and the disclosure and filing to me. In a special way, we want to thank Mrs. Sandra Moma. She's my senior, but I won't say more about that. I won't discuss the secret. So Ms. Sandra Moma is an associate partner, Ernst & Young.
Thank you.
Yes, of course. So she majors in all of this area. She described. I can see the authority with the way the facts she had shared. Thank you so much. And for our members, please, when you ask them a question, what we are giving here, we are not bound by any contract, and we are not liable to any different advice or consulting. You got the proper advice, you meet her, right? You meet our friend, or meet any other person who has been on this program. right? For them to give you details and get committed to the advice you'll be given. This is an on-air program, even though we've done, we faced it from a technical perspective. So thank you all for joining us. Thank you. Are over 308 members through the Zoom platform who joined us from across the length and breadth of Nigeria. Thank you so much. Our next edition is going to be on Thursday, May 4, 2023. So you will join us. We'll be discussing something all around. Okay, let me keep the secret for those who will join us then, right? We're going to have another power pack presenter like Mrs. Mama Sandra, who will do justice to all of this. I want to thank the secretarial guy from File Corporate Communications. Thank you. ICT, thank you. We've been a whole lot of work getting this ready, right? At the back of our, there's a lot of work, right? But we're happy we have it here. Thank you, cameraman. Thank you, President of CITN. Thank you, Secretarial staff. So, Mrs. Moma, thank you for coming once again. I've told you what, and they are watching. I told them you are going to come back here for the OECD, all of the pillar, and also transfer pricing.
Yeah.
So please, in your busy calendar, before you disappear out of Nigeria for your outside work, make provision for us as we go ahead. So thank you all. Let's have a good work day. God bless you all. Bye.